This is a silent trend that people not really talking about yet, and probably will be interesting to your viewers. But crypto trades, we started calling it cryptocurrency, right? Because it came as a means of payment. What does crypto do? It helps us make payments cross-border without paying huge fees and going through a SWIFT, waiting many days. What is currency really? Currency is a mean of valuating a certain ecosystem and assigning a value to a certain ecosystem. Traditionally, it came from geographies.
Like geography, like a countries, yeah.
Exactly. Crypto changed that narrative completely upside down. It's ecosystem. What is an ecosystem? Nobody knows. Now the ecosystem, if you imagine we create an index here right now on this podcast, and we say an ecosystem index is the rate of usage of one layer 1 or layer 2 or the other, hypothetically, right? How busy is it? And then we need to look into the fundamentals of what is the value of that ecosystem, that usage. What does that actually do? Only then we can determine and understand what is the value of this ecosystem, what does it bring right now. Crypto hasn't really decided, and there's a lot of commotion and fragmentation because it's not yet clear. One thing which is very, very clear, it's a great exchange, means of exchange for data. It's a great payments tool. It's a great tool for tracking.
What do you mean tracking?
Identity tracking, ownership tracking, any kind of data tracking, right? Because right now we're in big data world, so it helps. But when we compare it to the comparison that I drive with the foreign exchange is how it's traded in the market, right? Because foreign exchange has, take it high level, we can break it down into two markets. There's real money and there's fast money. So real money is people with real cash. They go to work, they earn salary, they go to Mercedes-Benz, they buy a car. Or they have a pension fund. Or they go and invest into an investment fund. That's real money because that drives real value and it requires real settlement. There is a cash transaction. There's value transfer from one person to another. Fast money is speculative. It's two hedge funds trading against each other on CME or in fast match or in hotspot. Right, various exchanges. They're speculating in price. They can be market making or aggressing or whatever the case may be. But at the end of that trading day, the settlement, if it's 1 or 2 or 3% of the entire trading volume, that's something. That's significant. Normally, the risk hedges out itself, and that is a speculative transaction of people speculating the real money is moving this way. Something happened fundamentally in the UK, let's say. Or we're becoming crypto friendly, we're inviting Web3 businesses, we're going to do this. If something like this happens, all of a sudden there's going to be a positive influx of the economy and the movement is going to start happening. That allows someone to speculate on market movement, right? But real money is much slower. So where is the real money economy of crypto?
I have no idea.
What's the point of Ethereum? What's the point of Bitcoin? What's the point of it's R&D and adoption and experimentation and testing phase. Because it hasn't become an integral part of your life, besides some of the emerging market countries that are trying to hedge their local currency risk because of unfortunate fundamental issues locally. But otherwise, it's very hard to predict precisely. One thing I can tell you, though, the institutional adoption side of things is going to change the way we interact with the crypto ecosystem, the centralized side of it for sure. An interesting aspect of that is, okay, let me ask you a question. What happens if Binance closes down tomorrow?
It will crash the market, I think, for 80%.
Why?
Because the people will lost the trust in crypto field, let's say in white crypto field.
True. The biggest risk of Binance going down tomorrow is people losing their assets because they're also hold assets.
Yeah.
The fun part is that Binance is also servicing institutional clients. Institutional clients in traditional markets do not trust their assets to an exchange. You can't come to CME and deposit money into your wallet. That concept doesn't exist. What normally happens is you have a clearinghouse, or you have a prime broker, or you have a bilateral credit agreement, and then you're allowed to trade on the exchange. An exchange doesn't care about your wallet balance. They don't have control or access. They just know that you have a certain credit limit or your...
And they just provide you a service.
Just a marketplace. And they're also not a principal. They don't take buy or sell positions.
Yeah, sure.
Can we say the same about crypto?
No, we cannot.
That's quite dangerous, right? So this is why crypto markets are very fragile. And I put huge amount of importance into development of execution-only marketplaces where big volumes can be executed safely, securely. Wash trading and print order book printing is no longer an issue. And those environments are regulated well enough so that nobody can scam the market.
So that's why we see the growth of the DeFi infrastructure, etc., because the industry needs something similar that happen in a real world assets.
Absolutely.
I didn't think about it in that way because I'm a retail investor. I don't use DeFi for myself, really.
I'm curious to see how DeFi is going to develop on the institutional space. The adoption of that is going to be something very new. But I think the technology itself allows us to build products and ecosystems that service the institutional needs in a seamless way. Starting from legal agreements all the way through to bilateral credit agreements, all the way through to settlement of assets, the whole food chain. And that's going to be very, very exciting.
What do you think? What will happen with the market, with the prices, with the volatility? After the institutional comes to this market, it looks like this market, it becomes
volatility shrinks. There's some sort of stability.
Why? What is the idea? Why volatility goes down?
Extremely high volatility like we see today is a sign of immaturity or instability of markets.
Okay.
Small events have massive impact.
Small events have massive impact. That's the definition of this.
Exactly, right? So like, okay, FTX went down. Okay, so what? Why do I need to care about FTX going down? How many people get arrested for all sorts of fraud and different kind of things? How many companies get closed down for different kind of weird activities? Do you care?
In general, no.
Yeah. Why do we need to care here? In my eyes, that's a small event in general in life. But because crypto is such a fragile and immature and small and a newborn ecosystem, that's a big event in a crypto ecosystem.
What needs to happen in let's say, a real market to move the prices of Apple or Tesla or Coca-Cola or other companies?
Changing in terms of stocks and stuff, but let's say, okay, now it's a stock, slightly different ball game, right? Stock has actual real value company performance.
Okay.
If I come up in Apple and they throw my quarterly performance numbers and I've blown it out of the park, yes, all of a sudden the stock goes up because everyone chases my success, right?
Okay.
If I've underperformed
everybody sells
my predictions, like something you've messed up somewhere, right? I don't know. Let's see how you're going to recover, and price starts climbing down. But crypto is slightly different, right? Let's see if you've taken trading Apple stock, you trade, I don't know, Robinhood, trading 200,
sure.
whatever. All of them have legal agreements.
So I have a question. If the Robinhood goes down, it will bankrupt.
Yeah. So why does that have to impact Tesla stock? Who cares?
From your perspective, it will not affect the market.
Absolutely
at all.
not. No, not
It
at all.
will affect only Robinhood.
And poor shareholders.
Interesting.
Well,
no, I agree with you. I agree. I understand the thing,
but
I
that's
didn't
how it should be, right? That's how it should be. That's what we want crypto to be like.